When stock markets drop, most investors do one of two things. They panic and sell, or they sit still and hope it passes. But there's another approach that becomes especially useful during market drops, having part of your portfolio in assets that are not directly linked to stock market movements. That means their performance is driven by different factors, not by what's happening on the stock exchange. These are assets that can keep paying you even when equities are falling. Some pay monthly interest, some pay rental income on a regular basis. And one doesn't pay anything at all, but it has been used to protect wealth for centuries. Let's take a look. We're going to walk you through 5 asset classes that behave differently from stocks: bonds, fractional real estate, loans, money market funds, and gold. For each one, we'll look at how it relates to stock market movements, what kind of income or protection it offers, and what trade-offs come with adding it to your portfolio. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research and consult a financial advisor before making investment decisions. Bonds are where many investors look first when they want something more predictable than stocks. When you buy a bond, you're lending money to a government or company in exchange for regular interest payments called coupons, plus the return of your principal, which is the original amount you invest at maturity. Maturity is simply the date when the bond's term ends and that principal is due to be repaid. What makes bonds attractive during market uncertainty is their predictability. For a standard fixed-rate bond, coupon payments are usually made on a fixed schedule and are not directly linked to stock market moves. For example, a 1,000 bond with 6% annual coupon would typically pay €60 a year in interest, regardless of whether the stock market is up or down, as long as the issuer continues to make payments. That said, bonds and stocks do not always move in opposite directions. When interest rates rise, bond prices tend to fall, and rate increases can sometimes happen during periods of stock market volatility. One key difference is what happens if you hold a bond to maturity. Short-term price changes matter less because you continue to receive coupon payments and the principal is scheduled to be repaid at the end of the term. Government bonds tend to be safer but offer lower yields. Corporate bonds usually offer higher returns but carry more credit risk, meaning there is a higher chance the issuer may not be able to repay. Next, fractional real estate. Rental income has a different dynamic compared to stock dividends. It comes from tenants paying rent rather than from how markets are pricing a company. When stock markets fall, people still need places to live and businesses still need space, although occupancy and rent levels can still change. That disconnect is what makes real estate interesting during volatile periods. The income may continue even when equity markets are under pressure. Traditional real estate requires a large upfront commitment. Buying a property usually means a significant down payment, plus additional costs like taxes, maintenance, and ongoing expenses. Fractional real estate makes that more accessible. You buy a share of a property and receive a share of the rental income. Professional managers handle the property, so your involvement is minimal. The trade-off is liquidity. Real estate isn't something you can always sell quickly, and if you suddenly need the money, it may take time. And the income isn't fixed. It depends on occupancy rate and local market conditions. So while it's not directly tied to the stock market, it still depends on what's happening with the property itself. Now, loans. When you invest in loans, you earn interest from money lent to borrowers. The rate and term are usually set when the loan is issued. Stock market swings don't directly affect whether a borrower makes their payments. That's what makes loans useful in a diversified portfolio. At the same time, loans are still linked to the broader economy. During a recession or a major crisis, borrowers may struggle to repay. If borrowers repay as expected, interest payments come in regularly, often monthly, regardless of what's happening on the stock market. Compared to government bonds, loan investments can offer higher returns, but they also come with higher risk. The main risk is credit risk. If a borrower defaults, you may not recover your full investment. That's why diversification matters. Spreading your investment across many loans helps reduce the impact of any single default. And unlike stock dividends, which companies can reduce during difficult periods, loan payments follow the original terms as long as borrowers continue to repay. There's another option for when you want your money working but don't want to commit it long-term: money market funds. These invest in very short-term, relatively low-risk instruments like government securities and short-term debt from large companies. The returns are usually lower than bonds or loans, but in exchange you get stability and easy access to your money. Your funds stay liquid and earn a return that generally moves in line with short-term interest rates set by central banks like the European Central Bank. What makes money market funds useful during uncertain periods is simple. They give your money somewhere to sit while still earning something instead of staying in cash and earning nothing. Returns are typically more stable than other investments, but not guaranteed. And you can access your money when you need it. And then there's gold. Gold doesn't pay coupons, interest, or rent. It generates no income at all. So why include it here? Because gold plays a different role entirely. It's a store of value, and historically, it tends to hold its price or rise when stock markets fall and currencies weaken. During periods of high inflation or geopolitical uncertainty, gold has often moved in the opposite direction to equities. The trade-off is clear. Gold protects purchasing power, but doesn't grow your wealth through regular payments. It's the one asset on this list that won't put money in your account each month. That's worth understanding because it sets gold apart from the other four. Bonds, real estate, loans, and money market funds all generate income. Gold preserves value. Depending on your goals, you might want both, but they serve different purposes. Before making any changes to your portfolio, consider what you're trying to achieve. Are you looking for income that continues regardless of stock market conditions? Bonds, loans, and real estate can offer that. Do you want a short-term parking spot for cash that still earns a return? Money market funds are designed exactly for that. Are you looking to protect against inflation or currency risk? Gold has historically played that role. Many investors choose to combine several of these, and the right mix, if any, depends on your goals, timeline, and comfort with risk. If you'd like to explore these asset classes for yourself, Mintos gives you access to bonds, loans, fractional real estate, and money market funds like Smart Cash, all from one account starting from €50. You can start by seeing what fits your investor profile and go from there. Which of these asset classes are you most curious about? Drop a comment and let us know. If this video helped you think about investing beyond stocks, give it a like. And if you're ready to start exploring, check out Mintos and see what fits your goals. Thanks for watching, and here's to smarter, more confident investing.